Homeowners Insurance Forms, Business 506, Cal Lutheran University. By the end of this lesson, you should be able to describe the types of coverage within the standard ISO homeowners forms. These policies typically provide coverage for a family's home, personal possessions, and liability that arises out of many activities of family members. The homeowner's policy is not a single policy, but a series of policy forms for which different types of situations and with different degrees of coverage. There are 6 standard insurance forms from the ISO Insurance Services Office: the HO2 Broad Form, the HO3 Special Form, the HO4 Contents Broad Form, HO5 Comprehensive Form, HO6 Unit Owners Form, HO8 Modified Coverage Form. Now, in the marketplace, 4 of these are very common. The HO3 and HO5 are for your regular homeowners out there. HO4 for renters, because just contents only, contents and liability. And the HO6 is unit owners, is for your condo people. Condos, tenants in common, any sort of shared ownership in a dwelling. The HO2, HO3, HO5, and HO8 are designed for owner-occupants for 1 to 4 family dwelling units. HO4 is for tenants, just mentioned that before, and the HO6 is for condos. As far as insured persons, so for purposes of the entire policy, these persons include 1, the named insured and spouse who reside in the residence, residents of the named insured's household who are relatives, and residents of the named insured's household who are dependents under the age of 21 and in the care of any of the persons previously mentioned. Additionally, a full-time student who was a resident of the insured's household before moving out to attend school, as long as the student is either under 24 and a relative of an insured, or under 21 and in the care of an insured. There are 2 other categories of persons who are considered insured for purposes of Section 2 liability coverage. The first being any person or organization responsible for animals or watercraft owned by anyone on the previous list. The second is any person employed by any one of the insureds on the earlier list with respect to any vehicles insured to under the policy and other persons using the vehicles on an insured location with the consent of the named insured. So you have a caretaker and you have a house on a large lot. It's a couple acres. And you have a John Deere Gator that you use in the maintenance and caring of the property. And you have a caretaker who's driving that. He's injured. Well, that's where this provision would come into place. So the insured location in a homeowner's policy, that is the residence premises, which includes the 1 to 4 family unit dwelling, other structures, and the grounds where the policy owner resides as shown in the declarations page. The part of the premises, other structure, and grounds used by the named insured or spouse as a residence, for example, a vacation home, if it is shown in the declarations or if it is acquired during the policy year as a residence by the named insured. Other premises not owned by an insured, but where an insured is temporarily residing, vacant land other than farmland, owned by or rented to an insured, individual or family cemetery plots or burial vaults of an insured, and any part of a premises occasionally rented to an insured for other than business use. The HO3 policy, property coverage. The HO3 contains 5 categories of property coverage. Coverage A is the dwelling, Coverage B, other structures, Coverage C, personal property, Coverage D, loss of use, and additional coverages that provide protection for assorted situations. Now, Coverage A for the dwelling is all risk property insurance for the residents, and it's going to cover everything except for what's specifically excluded. So what's excluded? Collapse, freezing and thawing of ice, visible mold, fungus, wet rot, inherent vice, latent defects, settling or shrinking, freezing of systems, vandalism, wear, tear, and deterioration, smog, rust, and corrosion, birds, vermin, rodents, or insects. In addition to the specific exclusions, there are several general exclusions also appearing in the policy. Typical exclusions: ordinance and law, water damage, owner neglect, nuclear hazard, government action, earth movement, power failure, war, intentional loss, acts or decisions, and faulty, inadequate, or defective design. Now, the HO3 can be endorsed up to remove some of the exclusions. So some coverage example. Is coverage provided for direct losses due to fire, lightning, tornadoes, windstorms, hail, explosion, vandalism, theft? Yes. But is coverage provided for vandalism that occurred while I was away in Europe for a 2-month vacation? No. Typically after 30 days, vandalism coverage is suspended. Another example. A pipe burst and water flooded my living room. Is there coverage? Well, the cost to repair the pipe is not covered because that's a maintenance issue. But the cost to repair the damage from the water inside the house is covered. Now, if my house is flooded after a severe rainstorm, are you covered? No, because that's separate flood insurance. So remember, a pipe breaking inside the structure, that's water damage. Then the damage from that water will be covered. But again, the maintenance of the pipe will not be covered. Coverage A limits are determined by the insured, and the insurer, whether it's agent or broker, will work with the insured to help determine proper coverage limits. Losses are settled on a replacement cost basis, subject to the aggregate coverage limits and the 80% coinsurance clause. Replacement cost is the amount necessary to repair or replace the dwelling with material of like kind and quality at current prices. So the replacement cost is established one of 3 ways: the insurer's own tools, a contractor's estimate, or a professional appraisal. An example: a home has a current replacement cost of $100,000 and insured for only $80,000. If the home is damaged by a tornado and the repairs cost $20,000, the full $20,000 is paid with no deduction for depreciation. If the home is totally destroyed, however, the maximum amount that we paid for damage is the face amount of the policy, or $80,000. Now, the coinsurance clause deals with situations when the coverage has diverged out over time to be less than 80% of the replacement cost. So, if it doesn't meet this criteria, the insured receives the larger of the following 2 amounts. The first being the actual cash value of the part of the building damaged, or this formula here, the amount of insurance carried divided by 80% times what the current replacement cost is, multiplied by the loss. So an example: home has a current replacement value of $100,000 and is only insured for $60,000. The roof of the house is 10 years old and has a 20-year useful life, so is 50% depreciated. Assume the roof is severely damaged in a windstorm and the replacement cost of a new roof is $20,000. Ignoring the deductible, how much will the insured receive? Well, the actual cash value is $20,000 minus $10,000 depreciation, or $10,000. Or the second formula, the amount of insurance that was carried, $60,000, divided by 80% times the amount of insurance they should have had, so $80,000 times 20, and that would leave $15,000. So the better of is the $15,000, and that's what the insured would receive for this particular claim. Now, most insurers offer a guaranteed replacement cost, option ID, that endorses up the policy when the insured agrees to insure the home for 100% and of its estimated replacement cost rather than 80%. So in the event of a total loss, the insurer agrees to replace the home beyond the coverage A level. And that ranges from 20 to 50% of coverage A, depending on the insurance company you're dealing with. Coverage B, other structures, provides all risk insurance for other structures on the residence premises that are set apart from the dwelling by a clear space. So the same perils and exclusions that apply to coverage A will also apply to coverage B, and generally limited 10% of coverage A unless a higher amount is available or requested. And again, coverage B limits 10% of coverage A, so that's pretty standard on the HO5 contract. It can be endorsed that way on the rental dwelling policy as well as the Homeowners Form 3, the HO3. Losses are settled on a replacement cost basis subject to the coverage limits and that 80% coinsurance clause. And replacement cost is the amount necessary to repair or replace the dwelling with material of like kind and quality at current prices. Now, coverage C, that is covering personal property, or to use slang, your stuff. Everything you move on into the house. The contents of the kitchen drawers, all the tools in the garage, your clothes, the TV, the couch, everything that you moved into the house is your personal property. and that's written on a named perils basis. Those perils include the following: fire and lightning, explosion, aircraft, theft, falling objects, volcanic eruption, windstorm or hail, riot or civil commotion, vehicles, vandalism or malicious mischief, and the weight of ice, snow, or sleet. Personal property coverage limits are generally 50% of Coverage A limits. However, it may vary by insurer. For example, if the Coverage A limit is $150,000, Coverage C limit could be $50,000. And again, some insurance companies will go higher for the standard amount. You might see 60, 70, 75%. And if the insured has a lot of contents, it can be endorsed up further to whatever the insured feels the right number is. And losses are settled on an actual cash value basis. However, there is an endorsement for replacement cost coverage that's very inexpensive, and I do recommend it regardless of the insurance carrier. Some Coverage C special limits. So $200 limit on money, banknotes, coins, etc. $1,500 for theft of watercraft, $2,500 for business property, $1,500 for jewelry, $2,500 for a theft of silverware, $1,500 for securities deeds, valuable papers, $1,500 for trailers, $1,500 for theft of electronic gear from motor vehicle, and $2,500 for theft of firearms. Some exclusions. Articles insured elsewhere, you can't get double coverage. Motor vehicles, a rule of thumb is if you have to register it, you need a separate vehicle policy for it. It's not going to be covered in the homeowners. Property of roomers or boarders, they technically need a HO4 renter's policy. So if you rent out one room in your house and the house burns down and you're still living in that house, all of your property is going to be covered, but the roomer or boarder will not be covered. Business data, animals, birds, and fish, aircraft, hovercraft, property rented to others, and credit cards. Coverage D, loss of use. Coverage D provides certain types of consequential loss coverage when the named insured's residence cannot be occupied as a result of loss covered under Section 1 of the policy. So generally, Coverage D limits are 30% of the Coverage A limits. And again, it depends on the carrier. There are a couple carriers out there who have no dollar limit on the Coverage D for loss of use. There are some that don't have it at all, but commonly you'll see 30% of Coverage A limits. So some other coverages. In addition to the basic coverages that we've already gone over, you can have coverage for debris removal after a loss. So house burns down, you need to remove out all of the burnt items. Commonly 5% for debris removal is available. Trees, shrubs, other plants, property removal, glass breakage, loss assessment coverage, and that's really important on the HO Form 6. But you could have an association with loss assessments on an HO3 or HO5 also. Reasonable repairs, fire department service charge. A note on that, many municipalities are now giving you a bill if the fire department comes out. Again, that can be endorsed up on the HO3 and HO5 policies. So credit card theft and fraud, grave markers, and collapse. Coverage E. That Section 2 Coverage E provides protection for damage for which an insured is legally liable that arise out of bodily injury or property damage. And the basic limit is $100,000 per occurrence. There are higher limits available, typically up to $1 million depending on the insurance carrier. And if the client is looking at $1 million coverage, again, we should explore a personal liability umbrella at that point. Typical exclusions for Coverage E arises out of losses that arise out of motor vehicle, aircraft and watercraft, arises out of business ventures or professional services, caused by war, caused by communicable diseases, or arises out of sexual molestation. Now, Coverage F provides for up to $1,000 of coverage per occurrence, and that's a standard amount, for necessary medical expenses of persons other than the insured. So, on the auto policy, medical payments covers you and everybody in your car, whether they're friend or family. On the homeowner's policy, it does not cover you and family members who live at home. It's going to cover people you invite in, whether they're friend or family. So your brother comes in from out of town, kids from down the street come over to play with your kids and one falls down the stairs and they're injured, again, medical payments would be coming into play there, and also potentially liability depending on the circumstances of the accident. Higher amounts are available. Typically, with most insurance carriers, $10,000 will be the maximum. Other Section 2 coverages, there will be coverage for claims expenses, first aid to others, $1,000 for property damage to others, and $1,000 for lost settlement against a corporation. Moving on to the Homeowners Form 2. It's similar to the Form 3, except for Coverage A and Coverage B are written on the same name peril basis as Coverage C, personal property. The form is most likely to be used when the cost of coverage is a major concern. It's less comprehensive and therefore less expensive. And very few insurers offer the HO2 anymore. The HO4, contents broad form, the renter's policy, so to speak. It's going to provide coverage for the renter's possessions as well as liability. So that's pretty much all that's in the renters. And again, there's no coverage A or coverage B because there's no ownership interest where the insured is residing. Homeowners Form 5 is comprehensive form. It is very similar to the HO3, except it's written on an all-risk basis. So all risk except for what is excluded. Homeowners Form 6, the condo unit owners form. Again, in a lot of big cities, you'll see a TIC, tenants in common. It's very similar. You have multiple families, multiple units, one building. So it's written on a name peril basis, and the form is usually used by owners of condo or cooperative units. The HO8, modified coverage form. Again, similar to the HO3, except all coverages are severely reduced. This form is usually used when replacement cost of the dwelling significantly received its market value. Older urban areas, for example. And here's a summary of the various forms. You can hit pause here for a minute to look at across the horizontal upper axis there, HO2, 3, 4, 5, 6, and 8. And on the left column, vertical axis, perils insured against, coverages A, B, C, D, E, and F. And unpause and move on. So again, in summary, we've gone over the standard types of ISO homeowners forms. And again, thank you as always for your time.